Hello, I'm a 21-year-old investor looking to compound my wealth in the stock market. And in today's episode, I'll be covering two main portions. The first portion, I'll be covering Netflix stock. And in the second portion, I'll be covering two other stocks that have been falling, that are compounding machines. So let's talk about Netflix stock. This is Netflix stock over the past 1 month. It's down around 10%. And year to date, it's up around 13%. From the highs in June this year, it's down around 25%. So the stock is currently trading at a 41 times of earnings. And before we get into whether or not Netflix is a buy today, maybe we can talk a bit more about Netflix mode. So Netflix has two main modes. So first of all is their distribution scale. So as you can see over here, they make up a substantial portion of global internet traffic. So what that means is that they have the ability to distribute, they have the ability to pass on all the content to many of its users because it has scale. And second of all is that Netflix has content IP. So this is intellectual property. This is similar to what Disney has also. So for Netflix, the proposition for this company is that it can build up the number of shows that it will have over time. So as they create more shows, as they pay for the licenses for more of these shows on the platform, the entire platform itself becomes higher value as a whole because you have more choices for your consumers to choose from. So this content IP is actually quite important for Netflix because it allows it to do something similar to what Disney has done over the years, which is to license out the content and to sell more products outside of their existing streaming platform. So for example, we know this Squid Game here, this is a major hit for Netflix. They have created streams of revenue outside of just the streaming platform on the app itself. So they're now into stores like this, they're into gambling websites that allow the use of Squid Game. And this is a lever that Netflix can actually pull over time. So another lever that Netflix has been pulling is this thing over here, which is Netflix Games. It's another venture that the company is going into. So what Netflix is trying to do is that it is trying to create an app that is almost an everything app for its users to increase the retention in the app itself, because higher retention naturally leads to more sticky customers. And what they're doing over here is they're trying to venture outside of just the streaming platform, outside of streaming just traditional shows. They're going into sports, they're going into games, and this actually increases the value proposition for its users also. And then the last lever that the company has been pulling actively is to try and venture into ads. So ads is one of the most monetizable way for a company to make profits once it has a large user base. This is what Amazon has done. This is what Alphabet, what Meta has done. And it has proven to be a very profitable stream of income. So what Netflix is doing over here is they're introducing an ads plan in US as well as 12 other countries. It is currently not in Singapore yet, but they're looking to expand this globally also. So ads is a very monetizable, a very high margin way for the company to make profits. And so far, it's been a success for the company because number one, you can attract more users because lower prices leads to higher willingness to pay from the customers. And second of all is that the company introduces another stream of income outside of the streaming revenue that the company collects. So I think we can all agree that Netflix is a decent company, a decent quality company. And this is actually showed up in the numbers also. So this is Netflix share of TV time over the past few years. And as you can see, it's been growing steadily over time, all while linear TV is declining in terms of market share. So one of the simple theses for Netflix is just the decline in terms of linear television and an increase in terms of streaming platforms like Netflix, like YouTube Premium, like your other streaming platforms also. And just taking a look at Netflix recent earnings, their earnings were great actually. So revenue grew by around 17% in line with forecast. Operating margin was 28%, which was below the guidance because of a one-time expense. And then everything was healthy for the company. I think the company is going in the right direction. And there's also another metric that I think a lot of investors are neglecting today, which is this thing over here, amortization of content assets. So what Netflix does is that it pays for the content, it acquires this content, and then it records it down in its cash flow statement in this segment here, this line item, which is addition to content assets. And then what they do every single year is they will amortize these content assets, typically within 4 years. So the lifetime expense, the lifetime duration of all these content assets is 4 years for the company. So what an investor must understand is this: your amortization of content asset, it allows the content assets to disappear after 4 years. But in reality, your content assets don't just magically disappear after 4 years. It is still existing content library that Netflix has that they can license out to generate even more revenue for the company. They can even do something similar to what they've done with Squid Game, which is to franchise the brand out to other different platforms. So your content assets, they still generate revenue for the company, and so the company is likely understating its earnings. And if you were to adjust the EBITDA for the company, it is likely a lot higher than what they're reporting today. So then the next question would naturally be, why is Netflix stock down? So Netflix stock is down because of this thing over here. So this is their acquisition of Warner Brothers Discovery. So over here it says that they're paying around $27.75 for Warner Brothers Discovery share, about an enterprise value of $82.7 billion. So normally when your acquisition happens, there'll be a transfer of wealth from the acquirer towards the company that is selling away the company, because more often than not, they will pay more than the enterprise value of that existing company. And that's why we're seeing the stock selling off. So besides that, I think the stock will likely fall in the coming months. Why do I think so? So Paramount is number one, coming in with a hostile bid for Warner Brothers Discovery. Not sure how that one would go. But the second one is simply just regulation. So there's regulators coming up and saying that Netflix deal with Warner Brothers is an illegitimate one because it is monopolizing Netflix. And they're likely going to face a lot of regulatory barriers because Ellison is very close to the Trump administration. And the Trump administration have also came out and said that they're not liking this deal. So this deal will likely be a headwind for Netflix. And when there's uncertainty, not so much a fundamental decline, that is when the stock price will fall. And in the coming months with these headwinds coming up, I could see Netflix falling a lot further than what it has fallen today. So then the next question is it now time for you to buy Netflix shares? So let's take a look at Netflix stock over here. So this is Netflix P ratio over the past 5 years. And as you can see, the median PE is around 42 times. So we're currently now at around the median for the past 5 years. In 2022, it traded all the way down to around a 15 times of earnings. And for the revenue for the company has been growing steadily over time. So revenue is currently around 16-17%. It is very healthy revenue growth. EPS has been growing quite strongly also as the company gains profitability, and I don't see this slowing down anytime soon. So for Netflix, I think the company is still expensive today, still currently trading at a 42 times of earnings, around a 45 times of price to free cash flow. I would like for this company to fall a lot lower, and hopefully this regulatory headwinds start to hit the stock and the stock falls down. And that is when I think is a more opportunistic time for you to enter into the company. Okay, so the next company that I'll be covering is MSCI. MSCI is down around 10% year to date, currently trading at a 34 times of earnings. And if you have to look at a P ratio over the past few years, the median P ratio is around a 39 times of earnings. So the company is trading at a discount relative to its median PE over the past few years. And the lowest point it actually reached over the past few years, it's a 30 times of earnings in 2024. When it had a one-day drop because of a subscription miss. So why exactly is MSCI a quality compounding machine? It shows in its fundamentals over time. So revenue and EBIT has been growing steadily over the past 20 years. And for MSCI, the reason why the company is so strong is because of these few factors here. So this is MSCI's moat. So first of all is brand name as well as network effects. So MSCI indexes are the standard language for your global equity exposure, particularly in non-US as well as emerging markets. So as more ETFs track MSCI indexes, what that means is that more people will link their ETFs to MSCI indexes to maintain consistency and benchmarking, which strengthens MSCI's dominance through network effects. And then second of all, it's the high switching costs. So asset managers, they use MSCI indexes to build ETFs, risk models, and systems. It reduces regulatory friction when ETFs are linked to MSCI products because MSCI is highly trusted by your regulators. And besides that, it's also easier for them to benchmark their performance against MSCI index ETFs. So as their CEO mentioned previously, the trouble required to switch outweighs the cost-saving efforts. And switching away from MSCI also introduces regulatory friction, disruption in operation, as well as investor confusion. So the last moat for the company is simply the intellectual property for the company. So data is gold, and MSCI owns a lot of them from the years in the industry. They built their proprietary ESG ratings model, risk formula, similar to what FICO does with their FICO score. It licenses, sources, cleans, structures, and models proprietary data at scale, something that cannot be replicated by other companies. So for MSCI, I view this company as a high quality company. There's also another argument to be made, which is that your US companies are a lot more highly valued as compared to your international stocks. And MSCI being one of the global leaders in international ETFs, what that means is that we could see an outflow out of US equities into more international equity because they're more fairly priced. And when that happens, you will see international stocks outperforming, which will naturally lead to MSCI's fundamentals growing at similar rates to your international stock price growth, which naturally leads to accelerated growth for MSCI's revenue. Last company that I'll be covering is Ferrari stock. So this stock is year to date down around 5%. From the highs this year, the stock is down around 25%, similar to Netflix shares. In the 2008 financial crisis, in your housing crisis, Ferrari only had a revenue decline of around 8%. It is a completely discretionary product for consumers, and yet in 2008, stock revenue only dropped by around 8%. This clearly shows that a lot of its customers are loyal to Ferrari, and there's a statistic online also, which is that 80% of existing customers, 80% of cars that are sold are from existing customers. And 40% of its customers own more than two Ferraris. So it clearly shows that there is a loyal consumer base there, and it's a brand that everyone desires to have. So this is a DCF for the company, a napkin DCF. So assuming 8% free cash flow growth over the next few years, all the way till year 10, and assuming a 4% terminal growth rate, the company's fair value is around $225 a share. So of course, the free cash flow can grow a lot faster if they execute more pricing power. So let's try and make adjustments to this. So this is what the markets are pricing into Ferrari shares today. So the markets are pricing in around an 11% free cash flow growth over the next 10 years, followed by a 6% terminal growth rate, which will give you a fair value of around $380 a share. It's a high quality company, no doubt. It has longevity built into it because the company prioritizes exclusivity. It's a brand that your rich people, your wealthy people, they desire. And what they can do every year is simply just to increase prices and to increase volumes by 1-2%. And you can easily get this 6% terminal growth rate. But for Ferrari, the stock is expensive. This stock will look a lot more interesting if it has a depressed valuation. Currently, I'm not seeing it yet. I hope you guys have found this video useful. Feel free to check out the Substack link in the description and invest safe.